All right, let's get right into it. Today, we are cracking open Morgan Stanley's crystal ball to get a look at the U.S. economy in 2026. We're talking about the huge, powerful forces that are about to shape the next 2 years. So, what's really in store for your job, your wallet, your future? Let's break it down. So, here's the big question, the one everyone's asking. Are we headed for a recession or a recovery? Well, Morgan Stanley's answer? It's not a simple yes or no. Think of it more like a massive economic tug of war, with powerful forces pulling the economy in completely opposite directions. And we are about to unpack every single one of them. Real quick, before we dive deeper, hit like, smash subscribe, and share this video with someone who needs it. And if you're looking for a top-tier real estate agent anywhere in the country or need life insurance, check out the links in the description. We've got you covered. Okay, so what's the roadmap look like? Morgan Stanley is calling for a slowdown first. They see the economy hitting its weakest point right at the start of 2026. But, and this is a big but, don't count it out, because right after that dip, things are expected to rebound. Let's get straight to the headline numbers. First up, the big one, real GDP growth. That's the engine of the whole economy. The forecast for 2026 is a steady 1.8%. Now look, that's not a boom, not by a long shot, but it is a sign of a slow, grinding recovery after we get through that initial rough patch. Now let's talk about jobs. The unemployment rate, it's projected to climb, actually peaking at 4.7% in the second quarter of 2026. So what does that mean for you? It means the job market is going to feel a little looser, a bit softer, before it starts to tighten back up in the second half of the year. And what about the thing that's been hurting everyone's wallet, inflation? Well, the key number the Fed watches, core PCE, is expected to cool down to 2.6% by the end of 2026. That is definitely a move in the right direction. But there are some serious crosswinds that are going to be pushing prices around. So what's actually driving these numbers? It all comes down to a massive policy gamble. Seriously, we're talking about huge government spending, controversial tariffs, and a real battle, brewing inside the Federal Reserve itself. On one side of this tug of war, you've got the government hitting the gas pedal hard. Massive fiscal stimulus, we're talking big tax cuts for consumers, and a surge in spending from this OBBBA is set to inject a ton of cash into the economy, giving growth a really solid push forward. But at the same time, you've got another force hitting the brakes, trade policy. The lingering impact of tariffs is going to keep the prices of goods higher than they would be otherwise. This makes inflation sticky, It prevents it from falling as fast as we'd like, especially in the first half of the year. And all of this, it leads to a major showdown inside the Federal Reserve. The central bank is totally split. You've got the hawks, who are looking at all this crazy AI spending and hot asset markets, and they want to keep things tight. But then you've got the doves, and they're looking at a weakening consumer and a softer labor market, and they think it's time to ease up. So, who wins this fight? Morgan Stanley is placing its bet on the doves. They're forecasting rate cuts all throughout the year, bringing that all-important Fed funds rate down to a target range of 3 to 3.25%. And that right there could be the key that unlocks the entire economic rebound. But, these big picture numbers, they don't tell the whole story. Not even close. Because on the ground, for real people, the economy is splitting in two. It's creating this K-shaped reality where the economic experiences of Americans are diverging, and diverging dramatically. And this right here, this is the core of that divide. The wealthiest 20% of households now control a staggering 71% of the entire nation's net worth. I mean, just think about that. This concentration has massive implications for who's actually spending money and driving this economy. So why? Why is the gap so wide? Well, a huge piece of the puzzle is asset ownership. That same top 20% owns 87% of all stocks and mutual funds. So when the market booms, they're the ones who reap almost all of the rewards, giving them this massive cushion to handle any economic bumps in the road. Real quick, before we dive deeper, hit like, smash subscribe, and share this video with someone who needs it. And if you're looking for a top-tier real estate agent anywhere in the country or need life insurance, check out the links in the description. We've got you covered. All right, now for the one question everybody is asking, what about housing? Look, affordability is still a massive, massive challenge. But with the Fed expected to start cutting rates, Morgan Stanley strategists see mortgage rates falling down to around 5.5%. That could be the catalyst we've all been waiting for to finally thaw this frozen housing market. Okay, let's shift gears and talk about the biggest wildcard in this entire forecast, artificial intelligence. Companies are pouring billions, trillions even, into AI, but its effect on the economy, well, it's a huge mystery that we are just beginning to unravel. And this brings us to the central paradox of AI, a line pulled straight from the report. We're seeing absolutely massive, robust spending on AI, but it's just not showing up in the GDP numbers. So where is all that money actually going? Well, the answer is kind of like an economic leak. A huge chunk of the money being spent on all this AI hardware and these components, it goes straight to imports. And since GDP only measures what we produce here at home, that spending, as huge as it is, doesn't boost the headline growth number for the US. But the bigger story here, the one you really need to watch, is the productivity payoff. History gives us a clue. Back in the 90s tech boom, it took 5 to 7 years for all that investment to translate into real, measurable productivity gains. The report suggests we're in the very early days of this AI cycle. The biggest benefits are still to come, likely after 2030. Now, of course, this baseline forecast is just one possible future. It's not set in stone. So Morgan Stanley also games out what could go wrong and what could go surprisingly right. Let's take a look at these alternate realities. So they've modeled a few different paths, like what if consumer demand just suddenly surges? Well, growth could rocket to 3.1%, but that would probably mean inflation stays hot and the Fed has to hike rates again. Or what if the AI revolution kicks in way faster than expected? We could see a massive productivity boom, boosting growth without the inflation headache. And then, of course, there's the other side, the risk of a mild recession, where growth just stalls and the Fed is forced to start cutting rates, and cutting them aggressively. So, what's the big takeaway here? The 2026 economy is not a foregone conclusion. Not at all. It's a battleground between massive government spending, a divided Federal Reserve, a deeply unequal consumer landscape, and a technological revolution that is really just getting started. The outcome hangs in a very, very delicate balance. Real quick, hit like, smash subscribe, and share this video with someone who needs it. And if you're looking for a top-tier real estate agent anywhere in the country or need life insurance, check out the links in the description. We've got you covered.